$1,000? Death of the 40-year bull market in bonds? What's next for the global financial system after Russia's central bank gets canceled? Hi. A few people in my company have asked me to do a buy the dip video, and I just can't bring myself to do that. I'm not very good at making sales pitches, and that one is so Jim Cramer-ish. Instead, I can tell you what I've always told you is why I buy, but I can also frame that today. This is important. I'm going to frame this in what is going on geopolitically right now and the economic environment. So gold and silver, precious metals, are not some short-term speculation. Buy the dip says that you're going to buy at lows and hopefully sell at highs. Well, markets go up and down. Gold and silver could go down for a period of a couple days or a couple months. Is this the bottom of the dip? I don't know. It could go down further, but it can't go down a lot. But gold will go higher. This is something I am very confident of. I'm not guaranteeing it for you, but I have bet my life that gold is going higher, a lot higher than where it is right now. And it is the geopolitical concerns that we've got going on right now and the rampant inflation that is the driver for astronomically high gold prices. So the risk-reward ratio, there is a little bit of downside risk potentially, but it's short-term, and that is limited by the cost of gold mining ultimately. The reward ratio is, as you're going to see toward the end of this video, pretty darn high. So this is the reason that I have bet my life on gold and silver. And here we have what's going on in the world today. So what's going on in the markets? The S&P 500 has rallied the past couple of days. So why is that? This is Friday, the 18th of March. Why have they rallied? Well, right here, the Federal Reserve announced that they did a 25 basis point rate hike. That's 1/4%. 100 basis points is 1%. So what does that mean? This is the dynamic yield curve. When the Fed goes and raises rates, they're talking about this one right here. This is the 3-month Treasury. This is the rate on the 2-year, 5-year, 7-year, 10-year, 20-year, and 30-year. These are bills, notes, and bonds. And so they raised this rate. But I want to point out a couple of things. This is the S&P 500 index, and you see this giant bull market that it's been in since 2008. But you can take this and sweep it across and watch that rate change. Now watch the 2-year, especially this second one, compared to the 10-year, right there in the middle. Whenever that inverts and the 2-year is higher than the 10-year, we have had a market crash along with a recession. And then here it is again, the 2 and the 10 invert, and then a market crash, the global financial crisis of 2008, a pretty severe recession. Then Ben Bernanke pegs us at 0, and it goes along, and Yellen takes over, and Powell takes over. We raised rates a little because they finally were able to generate some inflation, and they wanted to sort of slow down the markets. Well, you can see that the markets sort of freaked out over that. There was on again, off again tapering and quantitative easing, and there was one period of quantitative tightening, and then we have this big old market rally, and then the peak. And then it's pulling back. But watch here where they change the rates and they go up 2.5 basis points. Don't just watch the 3-month, but watch the 2-year. The 2-year went up like a full point. The 3-month went up a 1/4 point, but the 2-year went up by about a point. And the point of all of this is that the 2-year and the 10-year are very close once again to a spread that it doesn't take much now for the 2-year to be above the 10-year, predicting a severe recession and market crash. And I believe with what I'm going to show you next, how skewed the economy is now, that this would be the greatest crash in history and a very, very severe recession, one that may turn into a depression, which we may or may not ever come out of. Who knows what the future brings? I think that we will come out of it, but that will provide the opportunity. Gold and silver should go into some astronomical figures, and at that point, other asset classes will become undervalued, and that's when you do want to sell a portion of your wealth insurance that has given you spectacular gains and move into the next asset class that offers great gains. This is that 3-month Treasury bill. It's the yield on it going back to 1982. And what you see here, this is almost 16%. In the 90s, the NASDAQ started to go into a speculative bubble. Alan Greenspan called it irrational exuberance. And he started to tighten and raise interest rates. And here we are up at 6%, above 6%. And so he raised it until he popped the NASDAQ bubble and caused a recession, and then lowered it down too far and held it down too long. And he was trying to get the markets to go back up. He didn't see the real estate bubble that he had created over here. By the time he saw it, he started raising rates very methodically, very carefully, trying not to pop that bubble, but to bring us into for what he called a soft landing. Then Ben Bernanke took over, and we didn't have a soft landing. We had the global financial crisis of 2008. What did Ben Bernanke do? Bernanke was mopping up the disaster that was created by the Alan Greenspan bust. The Alan Greenspan created 2 busts. Bernanke's reaction was to take it to zero and hold it for way too long. He should have started the raising interest rates like he is now back in 2011. And they didn't. They kept it going. He started raising rates. Janet Yellen took over, then Powell, and then we had the global health crisis. They took it back down to zero. Now they've raised it just a tad there. What else happened during that period of time? Ben Bernanke took the currency supply from 0.8 something billion up to 4 billion. And then Yellen came in and did a little bit of taper. And then we did some quantitative tightening. I think this was under Powell here. And then that didn't work very well. We had a little crisis. They created a bunch of currency with repurchase agreements not measured in this graph here. So there was an emergency going on back here. They addressed that with repos. Then we have the global health problem. And this is where we are today. So, this is huge, from 0.8 to 6.1 trillion of base currency. So we've manipulated the economy in both those directions, interest rates and that. Now, I've been buying wealth insurance since gold was $315 an ounce, and I found out about silver when it was how undervalued it was back in early 2003. So gold since October of 2002. And I have been buying steadily through this whole thing. Now, there's some patterns here I'm going to discuss in a moment that are extremely bullish. You already know about one of them. But I want to point you to these 2 articles here. The Gold Market Update by Clive Mond. Slingshot advance is still in its infancy. Slingshot. So this is the big move. We are going there. There may be some pullbacks left. I'll show you something in a minute. But also read still huge upside from here on the silver market update. This is much bigger upside actually than gold because of the gold-silver ratio. But here's a pattern. I've mentioned the cup and handle pattern, which includes all of this. But there is also an inverse head and shoulders going on. We haven't broken the neckline yet, but when we do, look out. There should be some big fireworks. So what was going on back in the 70s? This is the 1970s here, and this was one of the greatest bull markets of all time. Silver went up 37 times its original price. Gold went up 24 times its original price. But as you can see here, the big move comes at the very end. And the difference here, if you compare this to the market that we've already had in precious metals, the move from the year 2000 up to 2011 was a greed-driven mania. And here, this big old spike here is a panic-driven buying spike in precious metals. So this is where, this is people chasing after gold and silver as wealth insurance. And so what drove this? What drove it was the Iran hostage crisis, the oil embargo, so very, very high oil prices, and raging inflation. Well, this is something I've been talking about, this bull market, for a decade. And I said, this is what drove it. But when I was saying that, I was saying that when we were fighting deflation and the Fed could not achieve 2% inflation target. They kept on creating currency, lowering interest rates, and nothing worked. They couldn't create the inflation that they wanted back then. So we were fighting deflation. We didn't have the threat of some huge war. Today, we have raging inflation, high oil prices, and the tail risk potential. But this is a potential. It's a tail risk. It's not the most probable outcome, but it's within the realm of possibilities. World War III. This isn't 50 hostages being held by a little hostile government that doesn't really have any weapons. This is the other great nuclear power and the United States. And to me, this is time for wealth insurance. So what else is different? Well, back in the 70s, if you look at this chart, this is the amount that the U.S. owes, our debt, as a percentage of gross domestic product. And it was down at 44% in 1941, and then with World War II, almost 120%. But in the 70s, you had 35%, 31%. It averaged about 1/3 of the U.S. economy. Now we're up at 106, but wait a minute, this chart stops in 2019. Why? It's annual data, and for some reason, they know what 2020 was, and now they know what 2021 was, but they haven't posted it yet. I wonder why. Well, this chart gives you historic context. It goes back to 1939. The next chart zooms up on it. This is quarterly data. It's as of the end of last year, except it only goes back to 1966. But still, you can see there's 30.8%, there's 30.7%, 30.6%. So that decade averaged about 1/3 of GDP, and now we're up at 123% of GDP, coming down from 136% of GDP. So we're already in this debt pit. We have these astronomical asset bubbles in stocks, bonds, and real estate. It's the almost everything bubble, not the everything bubble. Gold and silver are not in a bubble, and they were the number one, and until cryptos. Gold, the bull market of the 70s was the greatest bull market in the shortest period of time that mankind had ever experienced. And that day is coming again. So gold at $10,000, death of the 40-year bull market in bonds. What's next for the global financial system after Russia's central bank gets canceled? And then down here further in the article, the shockwaves are still being felt by the incredible Western sanctions. The shockwaves are being felt by the sanctions? Anyway, that have rendered the $630 billion in reserves the Russian central bank accumulated virtually unusable. Can the current dollar-centered global financial system last if money can be summarily canceled? Arthur Hayes argues that central banks will choose instead of dollars to load up on either gold, storable grains like wheat, or storable commodities like oil and copper. In essence, the largest surplus countries, fiat currencies, will implicitly grow their gold or commodity backing. Luke Groman says that of Forest for the Trees, says that the shift has happened even before the sanctions. Over the last 8 years, global central banks have bought about $260 billion worth of gold compared to $60 billion U.S. treasuries. This is something you need to keep an eye on because the world's central banks are sort of anticipating that something may be up. Russia has been one of the largest gold accumulators in the world for a long time now. So they were getting ready for something happening. So, in summary, what I want to leave you with is this. This is the Bureau of Labor Statistics inflation calculator. And if gold was $850 back in January of 1980 when it peaked, and it was at $850, according to the CPI, which always underestimates inflation, gold should be $3,099, so $3,100 today, according to the CPI. Is it headed there? I believe absolutely yes. Is it going to go far, far higher than that? I believe absolutely yes. What happens if we take a look at silver for the purchasing power it had back in 1980. We're talking about $182 silver today. That's where the price should be at if it goes into the same type of bubble, except the fundamentals are we're no longer paying off our debt. We're going deeper and deeper and deeper into debt, and we've dug ourselves this giant pit, which we will never climb out of without some sort of default. We have raging inflation again. We have really high oil prices, and oil is on very, very shaky ground. And we have the possibility of World War III. I can't believe that I'm saying that, but we've got these very dangerous scenarios out there. So gold and silver, to me, are the best wealth insurance. You've got health insurance. You've probably got enough. Do you have enough wealth insurance for what is going on in the world today?